Hi, welcome everybody. This is Standard Chartered's Business Innovation Series on Sustainable Trade Finance.
It's a pleasure to be on the panel today. This is Deniz Sarut. I'm currently responsible from running sustainable finance for Standard Chartered Bank in Europe and Americas.
My name is David Baldry. I'm based in Singapore, part of Standard Chartered's group trade product team, and I head up the team that onboards the buyers and suppliers under our supply chain finance programs.
I'm Yash Agrawal. I'm part of the trade finance sales team based in London.
My name is Wim Peters. I am Vice President of Business Development at EcoVadis.
I'm Michael Hart. I'm the Head of Trade Product for Standard Chartered.
Sustainability and sustainable finance are at the core of Standard Chartered Bank's operational decision-making process as well. And the bank has made several key commitments in support of sustainability and particularly climate change mitigation. This is a trend we're seeing across the banking industry, and the future of the industry looks like it will incorporate more and more ESG factors into decision-making more proactively. Prior to the COVID-19 pandemic, sustainability in all its manifestations were dominant themes across the way we were doing business as a bank. So during the pandemic, for instance, we have seen an outperformance of sustainable assets like clean energy, renewables, financial inclusion, etc., and with companies that best manage their relationships with stakeholders showing greater resilience. Environmental concerns and awareness in the wider community have also stayed very strong. What does this mean for a bank or the broader business community? As economies begin to come out of lockdown, the risks of new reality is clear. Social risks need to be taken into account, along with the impact of climate change. But we also need to harness the opportunities that is driven from these trends. As outlined in our Opportunity 2030 report, which was launched earlier this year and provides Standard Chartered Bank's SDG investment map, there is a 10 trillion private sector investment opportunity in contributing to only 3 SDGs, which is clean water, clean and affordable energy, and industry innovation. And this is only for select emerging markets. Adding the opportunity that can be unlocked through supply chains, we are looking at the biggest emerging markets. For our largest corporate clients, sustainable finance continues to be an attractive option. Linking finance to their sustainability strategy and broader ambitions across supply chains has always been a positive benefit. But this is particularly beneficial now, given that in the equity markets, companies which show leadership on ESG have outperformed their benchmarks. So we are seeing an accelerating focus on both economic and environmental sustainability, and together we must manage and protect the planet from climate-related risks. We also need to strengthen our social fabric by thinking locally and globally about ways and means of inclusion. We must drive economic activity and create value and spur economic growth. In that sense, sustainability is no longer just a nice thing to do or a matter of risk or compliance. It's a way of making decisions that brings money and purpose together.
Thanks, Deniz. I think that's really interesting. You've mentioned there in terms of a lot of the infrastructure and sort of the projects. Are you able to sort of give any sort of grassroots examples of where sustainable finance has materially made an impact?
Yes, happy to. Obviously, the bank has quite a big commitment around financing clean energy and sustainable infrastructure in the markets where it's needed the most. The bank operates obviously in emerging markets predominantly, but when we look at the emerging markets we are operating in, it's mainly the developing countries where access to energy is still an issue. So it's slightly different than providing financing to a renewable energy project in the Nordics when you're actually looking at opportunities in Bangladesh or Zambia and helping the livelihoods of the populations there. But I want to spend a bit of time on a big initiative that we have undertaken during the COVID months, which was our $1 billion commitment to finance at cost the companies providing goods and services to help fight the disease, and those looking to switch to these areas. So we have continued to support our clients and community during the pandemic by providing additional financing at a very severe liquidity crisis issue that were being faced in some of these markets. So recognizing the importance of sustainable recovery and immediate impact that we can create by financing, we continue to engage with our clients and offer them the funding that they needed in the most difficult times. Now, one of the most notable trends of the pandemic has been the rise of social investments, and I'd like to highlight these, given the panel is about supply chains and trade finance. And this is especially important across supply chains. How do you bring economic and social construct together and unlock capital towards tackling the virus or support measures for SMEs? So these are the concepts that we experimented around during COVID pandemic. And alongside our $1 billion lending program, we have been helping our clients to raise liquidity, to fund their response initiatives and integrate ESG principles across their supply chain financing.
David, to you, how are you seeing that we're moving trade finance and adapting it into SF for a client solution?
Great question, Michael. We're in the process of developing our sustainable trade finance proposition, which ultimately become a key pillar of the overall bank sustainable finance plan that Denise referred to. I think at the outset, we're really focusing on putting in place a robust governance framework and defining the standards around what qualifies as sustainable trade. And there's a few dimensions to that. The first would be really thinking in terms of sustainable goods and services, and the goods and services that we finance through our trade finance proposition. So, for example, defining standards and certification around palm oil, cocoa, coffee, some of the key commodities that we're looking to finance. The second element then, and Denise touched on this a little bit, is how do we bring a sustainability and ESG lens into our supply chain finance offerings, linking the sustainability performance of suppliers with the benefits that they can enjoy under our supply chain finance programs. And then thirdly, looking at other areas in the sustainable trade space. So how can we leverage sustainable trade solutions to support sustainable end use, to be that in the renewables space or sustainable infrastructure, but also not forgetting transitioning industries. So how can we leverage sustainability linked trade solutions to support the oil and gas industry, the metals and mining industry on their transition to become more sustainable? I think overall, in doing this, we're really trying to support our clients' sustainability agenda, help them achieve their sustainability goals through their sustainable procurement programs, and really serve as a catalyst, using trade finance, sustainable trade finance as a catalyst to support that positive impact across our clients' supply chains and ecosystems, and ultimately can contribute to sustainable economic growth.
And David and Yash, I'll just play devil's advocate just a little bit and for a second. Sustainable finance and supply chain finance, isn't supply chain finance already sustainable? I mean, how do we convince our clients that the term sustainable finance isn't just a hot topic or a fad for the market right now?
Personally, Michael, I really don't think it's a fad. I think for a couple of reasons. I think we're really seeing an awful lot of broad-based client interest around sustainable supply chain finance at the current time. I think obviously builds on some of the points that Denise mentioned, but I think given the COVID pandemic, I think there's been an even greater focus around sustainability. I think for corporates, sustainability is a key strategic priority. And I think a lot of corporates are now asking the question to say, look, how can we marry the benefits, the financial and working capital benefits of a traditional supply chain finance program by bringing in that sustainability lens to really, as I say, drive that positive impact through the supply chain and have that broader social and environmental impact on the supply chain. And I think also the point Denise raised around the recognition and the research that shows that sustainable companies are better performing companies. I think there's a strong linkage between sustainability and financial performance. So essentially, I think corporates are realizing a more sustainable supply chain is a stronger supply chain, a more secure supply chain, and brings that resilience in. I think it's really important.
And Yash?
I think, Michael, I agree with David. I think corporates do understand that being sustainable is directly linked to their trading partners, like their suppliers and their dealers being sustainable. I think to your earlier point, whether current SCS programs are already sustainable, I think the fact is that most supply chain finance programs that exist in the market today are mostly, offering a cheaper source of liquidity to the corporate suppliers, and very few programs in the industry today are really linked to any sort of sustainability metrics, etc. So that's the reality. I think what needs to happen, and therefore the challenge in front of us, is to really link supply chain finance programs to sustainable metrics. And when I say that, measured and monitored by third parties and at a global scale, I think that needs to happen. And secondly, I think we need to kind of implement newer or what we call blue ocean solutions that enable cheaper financing, not just for immediate suppliers, but for, smallholders like farmers, tier 2, tier 3 suppliers, things like that. I can very quickly quote a couple of examples on what we've been doing in that space as examples. So, for example, we're working on a project where we're trying to streamline the e-procurement from Africa for a couple of clients, and that involves, removing middlemen from the entire supply chain, providing cheaper financing to the farmers, as I was saying, and then tracing the origin of goods end to end. That is what does not exist today in supply chain financing programs, and that's what we're trying to bring in. The other example that comes to my mind is that we're kind of collaborating with a lot of investors like CDC, Asian Development Bank, who have the same vision, and then they want to kind of put money into projects that have a sustainability angle, especially related to the African, Asian markets. So I think those are the things that need to happen and have not happened till now.
Thanks, Yash. I'd be really interested, Wim, as well, from your perspective. Yash and both David there just sort of referenced the banking industry working with independent and third-party agencies. I think it'd be a really good point, actually, just to bring you in and hear from you. How do we get this message out to clients, and how do we then build a sustainable solution for trade?
We've seen in the wake of COVID and the relief measures that many governments have taken is linking all the relief measures to conditions on sustainability, be it mostly carbon related, but also other sustainability measures linked to relief measures. And I think most of the big corporates out there, many of the big clients of Standard Chartered, will be expecting new tools to help them leverage sustainability as a reason to get access to certain benefits, be able to deliver to your clients as a supplier, or to get access to finance. The big challenge, I think, for the banks will be to open up the opportunity for early finance for suppliers, is to move it down to the mid-sized and small suppliers, smallholders like you just mentioned. Typically, I see supply chain finance being focused only on the biggest suppliers, the biggest flows in the whole spend. This is going to be the challenge for both the banks and the buyers alike. Defining sustainability cannot be done by either the bank or the buyer. I think there's also quite a bit of supranational legislation coming out, taxonomy being created by the European Commission about what defines sustainability on a bank's assets. There will be very strict measures as to how sustainability is defined, and whether you need third-party objective proof-based due diligence to determine sustainability. So that's where I think, as it has happened in sustainable investment for publicly listed companies in the past, making sure public companies continue to get access to shareholders and pension funds and big investors on the basis of being sustainable and transparent. In the same way, banks and buyers will more need to be very aggressive on this field to make sure they continue to get access to financing their supply base on a sustainable way.
Thanks, Wim. No, I think you've made some really interesting points there. I've just made a few notes because I want to come back to them, particularly over the regulation piece and how we get that down to the small and the medium-sized clients as well. From your perspective, how do we get there faster? How do we get to deliver a solution that works for our client base?
Michael, maybe I can start. I think there's a few sort of key challenges we need to solve. I think we've touched on some already. But I think for me, a lot of this is around transparency and trust. So clearly we need to be able to measure, report the impact in a very objective way and really show that these sustainability programs are having the positive impact across the supply chain. Now, to do that in a scalable way, I think clearly sort of working with partners like ESG rating agencies, as we mentioned, who would obviously sort of be able to support it in terms of the data around enabling that, the digital tools around enabling that, which ultimately will then drive the scalability. I think really here it's sort of marrying that transparency, trust, data digitization to really sort of drive that scalability point. And I think the other element here, as we've touched on as well, is that whole piece around collaboration. I think no one institution can do this on their own. It's really about corporates working with banks, working with ESG ratings agencies, working with fintechs in this space to really pull this together and deliver something that's scalable in terms of an overall sustainable supply chain finance solution.
It's very rare to find a common passion or common aspiration that a bank, a regulator, and a corporate, shares, right? Like sustainability and some of these stretched goals we are setting for ourselves. I think the enabling environment, particularly in Europe, driven by European Commission, as Wim said, has opened up the debate for broader collaboration across regulators and across markets. And financial markets are adapting to this quite rapidly, right? In Europe and US, with the loan markets and bond markets, there has been an explosion of sustainable financing. I think when it comes to emerging markets and particularly the private debt space, including trade finance, the importance of collaboration, transparency, and digitization are the key themes. And we need to all work as an industry to create such tools to be able to unlock capital for, as we always say, where it is needed the most.
The key sort of message I'm sort of hearing from what both Denise and David have said is, we're looking at data, we're looking at transparency, trust, and scalability. Again, from a banking industry and with clients, how can we collectively work with firms like EcoVadis to enhance that transparency?
I think it's an interesting thing how to make supply chain finance, sustainable supply chain finance. It's basically a crossing between the banks and the financial world and the Treasury Department at your clients, but also the procurement departments and the sustainability departments. And here's an interesting thing. Most of your clients have been very focused on making their supply chain sustainable with sustainable supply chain programs or responsible sourcing programs within the procurement world by itself. And the interesting thing here and the challenge for all of us will be, how can we connect the Treasury Department and the CFO's office with the CPO's office and the CSO's office? And how can you then connect that with some clear financial benefits that we can offer to suppliers that are willing to be transparent and have a good score or willing to improve? And so this is both a challenge, but I think also the opportunity for companies like EcoVadis to say, hey, we can help you connect to the CPO. We can help you make sure you have a combined value proposition to the suppliers so that not only if they are transparent, they can continue the business with their customer or get more business with their customer, but also get access to that finance. So this is the big challenge in implementing. Yeah, to continue on the topic, the rating by itself of a company is not going to make anything sustainable. It's linking the rating to the willingness of the buyer to connect benefits to being transparent or to improve, or to connecting benefits from a financial perspective to getting access to that capital as a condition of being rated, as a condition of getting progress in the rating. This is going to drive impact, not just the rating itself.
Yash, I'd just like to be interested to sort of hear your thoughts and your insights in what we're already seeing. I mean, we're seeing sort of bespoke solutions around sustainable trade finance already. Have you got some examples that you can share?
I think Michael, I think a variety of themes are being worked upon, to be honest, by different players to push the envelope in this particular space. I think the first theme that I'd really mention is, which I think everybody on the panel has kind of mentioned before, is really digitization, because I think that is the key to everything in this space. When you have data that can prove, traceability, that can measure supplier performance, it does seem to be the key to really move forward with the space, and banks, corporates, everybody can plug in that data to really have some effective conversations. I think the second stream that people have been working upon, including Standard Chartered, is on newer solutions. So I think my friends from the corporate industry will kind of agree that most supply chain finance programs today that exist are post-invoice approval. So once they've kind of approved their invoices for their suppliers, most financing programs are based on that. What needs to happen are newer solutions like pre-shipment financing and deep tier financing. And by pre-shipment financing, I mean financing suppliers based on purchase orders from bigger corporates. And by deep tier financing, really, I mean financing tier 2, tier 3, tier 4 suppliers of bigger corporates. I think those are the solutions that really need to happen. Those are the innovative ideas that really need to be implemented. The challenges there really, and whenever I kind of talk about pre-shipment financing at Standard Chartered, the first question that gets thrown at me is what about the credit risk element, and what about the financial crime risk element? Have you thought about that? And that really then brings me to the earlier point about digitization. So if my answer always is that if there is sufficient data, to prove that based on the historic performance of the supplier, the risk is much lower, then it becomes a much easier conversation, and hence banks need to really look at their credit assessment models to be really, offering such solutions to suppliers. But then this argument of mine always gets flipped around to me, and then everybody and every corporate is like, corporates are willing to share that same data today as well. So what new do platforms kind of bring forward? I think the point I'm trying to make here is that banks need to really look at credit assessment models. Banks need to start using data for credit assessment and start offering programs like these. As at Standard Chartered, I can share that we've been looking at pre-shipment financing for a while, and we've successfully implemented program-based pre-shipment financing for a couple of corporates for their suppliers in Asia. We've done that, and we're trying to scale this up. Obviously, these early days, but we're trying to scale this up with other clients as well. I think the last work stream that I really want to kind of mention also is around collaboration. I think there are 5 key parties in this entire space who need to really come together. Government bodies, B would be philanthropic bodies. There is a lot of philanthropic money who are willing to kind of invest into such projects. C, banks, D, corporates, and E, obviously the fintech platforms. I think all of these 5 need to come together to really find these innovative solutions and really implement them.
I'd like to thank all the panelists that shared their views today. I think they're all incredibly valid. And I'd like to highlight the openness to collaboration, certainly from Standard Chartered Bank side, because we recognize the enormous investment that is required, particularly in the markets that we operate in. And it's not an undertaking of a single organization or a single supply chain. And we need to all come together, as Yash mentioned, as the financiers, as the investors, as the private sector, as the third-party experts in ESG, and build the tools necessary to scale it up in a significant way. And we remain committed to driving sustainability across EM.